Hey folks, I am Lance Hocutt with the Lance Hocutt Financial Group here in Tuscaloosa, Alabama. Although both the markets and changes to information around the COVID-19 virus are very fluid, given the recent concerns, we felt it was appropriate to reach out to everyone and provide an update. In Thursday of last week trading, the S&P 500 closed down 9.5% for the day and 16.5% for the week, pushing the S&P 500 index solidly into bear market territory, which, by the way, is defined as a market in which the value of an index declines more than 20% from its most recent high. On February 19, the S&P 500 hit a closing high of 33.86, and at Thursday's close, the S&P 500 was at 2480 for a decline of nearly 27%. So, this brings an end to the longest bull market in U.S. history, just over 11 years to the day after hitting lows during the financial crisis on March 9th of 2009. Additionally, this has been the fastest trade-off from a high to a bear market in U.S. history, as the S&P 500 hit an all-time high just 22 days ago. Markets today, Monday, March the 16th of 2020, are experiencing continued volatility. What started this? The bear market has been triggered by two exogenous events. The most significant is the spread of the new coronavirus, COVID-19, which has accelerated outside China and was declared a pandemic by the World Organization on March 11th. The virus has now infected nearly 140,000 people in 125 countries and led to nearly 5,000 deaths. In efforts to contain the spread of the virus, healthcare authorities and government leaders are encouraging social distancing, which is the act of limiting exposure to large public gatherings and using reasonable space requirements when around others. This will continue to have significant direct impacts on travel, leisure, and retail. Additionally, following a breakdown in OPEC talks over production cuts last week, Saudi Arabia slashed oil prices and indicated plans to increase production. Since then, oil prices have declined over 32% and triggered significant losses in already depressed energy-related equities. Unfortunately, the impact of these combined events has not been limited to those sectors of the economy that would at first glance appear to be most directly affected. For example, the financial sector has suffered some of the most significant declines as investors fear that potential credit losses from distresses in the oil sector and a broad economic slowdown will combine with dramatically lower rates to negatively impact profitability. In fact, all sectors of the S&P 500 have experienced double-digit losses from the start of 2020. Where are we now? Heading into this, the U.S. economy looked strong by many measures. Unemployment was at a 50-year low. Job growth was high and exceeding expectations. Consumer confidence was strong. Manufacturing appeared to be expanding following the trade agreement with China, and the housing market, as measured by starts and permits, was surging to decades highs. In fact, the Atlanta Fed, using their GDP Now gauge, indicated the economic data was consistent with economic growth of 3%. Also, corporate earnings growth was expected to rebound to the high single digits in 2020. However, the rapidly evolving events highlighted above will certainly change this trajectory and reduce economic activity and corporate earnings. No one knows how long this will last and how severe it will be. Opinions vary widely, and no new consensus view has had time to develop. Additionally, headlines stressing market trade-offs, canceling of events, and the closing of offices and schools have certainly stoked emotions and fears. This environment of uncertainty has therefore created extreme volatility in the market. What are we doing now? First, we're looking at past bear markets to see the range of historical outcomes for potential insights into the current situation. As highlighted in the following table, There have been 13 previous bear markets since the end of World War II. Although magnitude and duration vary, the average decline for all bear markets over this period has been around 32%, which improves to a 30% decline if we exclude the financial crisis of 2007 and 2008. Secondly, we are looking at alternatives across asset classes. While equities have experienced a dramatic drop in prices, safe haven U.S. Treasuries have rallied to fresh highs, pushing yields to the lowest in history. The 10-year U.S. Treasury currently yields 0.88%. Not only is this low on an absolute basis and relative to recent inflation levels, it is also extremely low relative to the current dividend yield of the S&P 500 of nearly 2.5%. In fact, the dividend yield on the S&P 500 exceeds the 10-year Treasury yield by more than any other time over the last 50-year period that we can track. In summary, we expect continued volatility for the next few weeks to months as we develop a better sense of how the COVID-19 crisis will play out and see more data around the impact on the economy and corporate earnings. For clients in our fee-based discretionary account, we have made proactive moves to help mitigate recent market volatility. For those clients not in those fee-based discretionary accounts, I recommend you reach out to our office as soon as possible so we can have a conversation of your risk tolerance, your time frame, and make certain that your needs are being met. For our 401k clients, please work with the 401k platform that you're on. If you need our help in allocation, risk concerns, please reach out to our team here and we can come and visit you at your convenience. From a logistical process, in an effort to protect our clients and our staff, we will conduct all prior scheduled appointments via phone conference all the way through the end of March. After that point, we will assess the situation and notify everyone as appropriate. As usual, a member of our staff will confirm your call the day before our scheduled time. Folks, please stay healthy. Do not hesitate to reach out if you need us. Thank you for allowing us to serve you. God bless.